Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surbi and Nigel. Guys, good morning.
Hi, morning.
Morning, folks. I guess we're starting off this week on a bit of an optimistic note, right? Because the markets kind of found their mojo, and the bulls will hope they can continue the charge.
Well, that's right. You've got one queue that's out of the way, the domestic queue that we've been waiting for, the Bihar elections. And now all eyes on, hopefully we get a trade deal soon. So lots to work with, though, with regard to this Bihar election outcome.
Absolutely. And I think, that outcome on Friday was, of course, spectacular. And we'll talk more about this. I mean, of course, the other one was it's actually pretty positive in terms of the picture out there, and expectedly perhaps a trade deal sometime down the line as well. But let me just start from the beginning, right? So this is all, in that sense, known to the market. I'll start with something where there is a little bit of, not fear, but a little bit of anxiety. And I'm starting with something which did not happen. So Kospi on Friday sold off 4%. And thankfully, and I'm using the word thankfully, we did not see a repeat of some of that in the US session. Only partly true though, right? And why do I say that? Nasdaq futures on Friday actually briefly dropped about 2% into open. They finally ended about 0.13% higher. I mean, that's the cash Nasdaq closed about 0.13% higher. The S&P 500, and by the way, it broke the 55-day moving average, which is the Nasdaq. That's a level which has been largely held all the way from the Liberation Day lows in the month of April this year. The intraday breach, and then we managed to close above it. The S&P 500, that recovered over 1%, 1.3% from the lows, and that ended absolutely flat. So, the final closes in that sense for Friday are kind of meaningless. Similar kind of picture on the bond prices as well. So the 10-year Treasury yield saw almost a 9 basis point reversal. So we ended about 3 basis point higher to about 4.15%. So the point I'm making is, especially the worry in that sense may, in the incremental next move in that sense, perhaps what we need to be watchful for is the US and what may happen in the US. Because you just look at some of the price action over the last few days in the US. Sometimes intraday, always okay by close, sometimes not okay by close, but that is rarely so. And it tells you that maybe, people are getting a little anxious about what lies ahead. I mean, it's nothing, there are those who are worried about the underlying sort of US consumer and the health of the economy and bankruptcies in the US, etc. I'm not even going there. I'm just talking about the both high and relative absolute P multiples for some of the high growth areas like AI, etc. Okay, so that's that, right? On the bond market, Fed hawks continue to express skepticism about a December rate cut. And there were two gentlemen who spoke on Friday, adding to that skepticism whether inflation is still running too hot, etc. Oil prices were up 2%. We're at about 64 plus. Geopolitical concerns in that sense, both out of Russia, Ukraine, and Iran as well in the Gulf. You got gold, which was on the back foot. Again, broader kind of liquidation move, but that was more intraday. US shutdown ending. Markets, of course, are waiting and watching for data. We perhaps get the September jobs data, which will come out on Thursday and Friday. Thursday or Friday, I mean, most likely Thursday, but we'll see. The Bureau of Labor Statistics is expected to release a calendar of data. Remember, there's no October data, most likely, as the White House has said. So the September number, in that sense, becomes important. And it's a big week for earnings as well. NVIDIA will report numbers on Wednesday, and that, I think, will be important for the overall equity sentiment. But it's not just AI. I briefly mentioned the US consumer. Walmart will report, Target will report. And I think, markets will be watching closely what those numbers are really showing. On Sunday, yesterday, Treasury Secretary Besant was on a television channel saying that hoping to finalize a rare earths deal with China by the end of November, by Thanksgiving, basically, by that time. So, and, we'll talk more about China a little later. But I think that's the bulk of it, right? It's in the US at the margin, a little bit of worry whether we perhaps see one round of shakeout. I mean, markets are not breaking, but maybe will they bend is the question. Now, just to tie in the levels here, they don't change very much. Targets 26,100 on the Nifty. Support at 25,777, which is the 20-day moving average. And then the 40-day exponential, which is 25,486. The Bank Nifty support is 58,004, the 20-day moving average. That is the 20-day moving average. And then the swing low is the 57,158 levels. So those are overall numbers, what we're working with. GIFT Nifty is indicating a 50-60 odd point higher start, and then we will pick it up from there. The F&O positioning and the stats there, Nigel is standing by with exactly that. Nigel, over to you.
Well, we had a big flare-up in the final hour of trade in Friday's trading session, and that's where the Nifty ended in the green. And, the NDA coming up on top in Bihar, that's definitely good news for the equity markets, ensures continuity as well. But there are a couple of other questions that are coming about now with regard to the fiscal map, because the fiscal deficit in a state like Bihar is already at elevated levels at around 6% or thereabouts. And with this cash being doled out, how do they fund this is going to be important. So the fiscal mat is still in question. While there are hopes now that the India-US trade deal could actually get a leg forward. And that's because Bihar produces a large amount of maize. And remember, India's demand for maize is actually quite high, while the US has surplus of maize, which INCRED points out could be one of the factors that helps in moving in the direction of getting a trade deal. So that's going to be the next important cue from an Indian market perspective. The FIs, yet another trading session they sold, and actually they sold larger than what we've seen in the previous few trading sessions, so around 4,000 crores or thereabouts. Moved to the futures data. The FIs, they've been adding shorts, and that's precisely what they did. Close to 9,500 short contracts is what they added. Even on the stock futures, they added close to around 3,000 contracts. So there were shorts that were added in Friday's trading session in a market that actually zoomed up in the final 60 minutes. And if you look at positioning right now, as a percentage, it's reaching the upper end of the range. Normally, when the FI net short positions reach around 91, 92% or thereabouts, that's when you see a bit of a short covering bounce that takes place. We're almost there. 89% in absolute terms, it's around 1.7 lakh contracts, while the clients, they are net long with close to around a lakh contracts on the long side. Move to the options data, 26,000 call. For the last few trading sessions, you've seen a lot of open interest addition out there. The premium's now at around 70 rupees or thereabouts. While the 25,700 put, well, out there, the premiums come down to around 35 rupees. So just plugging in the options data, looking at the technical levels as well, the first reference point on the downside actually comes in at around the 20 DMA. But if you're looking at the options data, then you're factoring in that the support comes in this 25,650 to around 25,700. The 20 DMA is a little higher than this, but the options data suggests that this is a crucial first level of support that we're looking at. On the upside, going by the options data, the resistance comes in at around this 26,080. The Nifty Bank, that's the one that's been leading the way even in Friday's trading session. That did a U-turn, and that's why we moved up. The reference point clearly is that 57,500 mark, because we've gone there numerous times, and from there, we have seen a bit of a bounce. So the Nifty Bank will have to continue its good form. It's already at an all-time high. So that one will have to lead the way. Let's see how it goes from here. But that 26,050 odd mark is the resistance zone. The US trade deal, can we see something in the near future?
Absolutely, that remains the biggest trigger perhaps now with the Bihar elections out of the way. By the way, the Asian region is actually more red than green. Barring South Korea, so the Kospi after that 4% slide on Friday, it's pulling back. Kospi is up about 1.7%. But other regional markets, whether it's Japan, where the numbers have come out, in terms of growth, and there is actually deceleration that continues in Japan. That Hong Kong is down as well. Mainland Chinese markets are down. So Asian screens are more red than green. We'll see how that plays out. Let's just get the implied open. I mean, we can see it on the ticker over there. It's suggesting that the bulls will keep building on that positive streak, that momentum that we saw on Friday. Right now, it's indicating a start almost 60 points higher. Okay, so let's, get along the way. We have our equity call of the morning coming through. Sanjeev Prasad of Kotak Institutional Equities says that the market may be stuck between one, positives of stable macro, stabilizing earnings, and a likely strong recovery in earnings in FY27, and two, the negatives of rich valuations and an uncertain global outlook. He also says that the retail sentiment continues to be fairly optimistic, but would need watching given dwindling trailing returns. He adds that the second quarter was quite mixed in the sense of results and earnings. He said numbers were distorted by GST rate cuts. Okay, so that's a view from Kotak Institutional Equities. By the way, before we get to our first guest of the day, let's also take stock of some of the sound bites that came in from Mr. Scott Bessent, and this was an interview with Fox News, where the US Treasury Secretary said that he hopes the rare earths deal with China will be done by Thanksgiving. Take a look.
I think that Wall Street Journal reporting is not very accurate. We haven't even finished the agreement, which we hope to have done by Thanksgiving. And I am confident that post our meeting in Korea between the two leaders, President Trump, President Xi, that China will honor their agreements. Xi Jinping has great respect for President Trump. The meeting was conducted very high level, and I am confident that they will honor their agreement, and if they don't, we have lots of levers.
Okay, so that's the all-important rare earth deal. At least we had all the right verbiage around it when that high-level meeting took place between the US and the Chinese presidents. Now, Besant also said that he's expecting to see a substantial acceleration in the US economy in the first and second quarters. He says that 2026 is going to be a great year for working Americans and for the markets.
I think we are going to see a substantial acceleration in the economy in the first, second quarter, and I think we are also we're already seeing on many prices. As I said, we're bending that curve down, and the increase in real incomes. I think Americans are going to feel it in the first quarter, second quarter. I think 2026, thanks to President Trump's signature plans, is going to be a great year for working Americans, for the markets. I call it parallel prosperity. Main Street and Wall Street can both do great, but I think Main Street's going to have a great year in 2026.
Okay, that's Scott Besant. Cameron Brand, Director of Research at EPFR Global, is with us now. Cameron, great to have you in. Let me start right there. Do you concur with that view? That working Americans are going to have a great 2026, because now we're coming out of that dark tunnel, right? The no data tunnel. And we'll get a better sense of what the jobs market is looking like, what's happening with the economy. But what's the sense when you're looking at flows that have been, the way they've been shifting in the absence of this data? What does that tell you?
Well, in the absence of data, people have hung on to the technology, artificial intelligence story. Basically, and as you know, we look at this from the mutual fund flows perspective. We've seen an acceleration of flows into technology sector funds and dedicated AI funds during both of the bouts of recent turbulence triggered by AI concerns. Turning quickly to the question you kicked off with, I certainly think the U.S. economy is going to do well next year. There's a fair amount of fiscal stimulus in the works. The trillion-dollar question is who'll get the bulk of the benefits, and that's not quite as clear.
Cameron, morning. The big question here in India as we wind down this year is, of course, whether foreigners are going to make a comeback. Are you sensing that in flows and the weekly data that you track, both global emerging market funds and other kinds?
I'm afraid not at the moment. What I'm seeing certainly towards emerging markets is a rather arbitrary distinction between countries that investors think will ride the early stages of the artificial intelligence boom and all the rest, though Latin America's been getting a little bit of a pass recently because they have big reserves of things like copper and lithium, which are needed to sort of make the infrastructure reality. So, there's been India has been somewhat bypassed. Flows have primarily gone to funds dedicated to China, Korea, and Taiwan, and then Brazil and Chile as resource plays.
Okay, Cameron, what about, the flows? Basically, we obviously here in India would like the FIs to come back after the kind of selling that they've seen. But between, emerging markets and developed markets, how do you see, flows pan out? Because one side of the market is talking about the US markets being a little overhyped, being expensive and entering into a bubble terrain. But they continue to chug along. So how do you see flows moving between developed markets and emerging markets?
Well, at the moment, certainly in relative terms, it's been fairly equal. In raw dollar terms, it still favors developed markets just because they are developed. So investors are certainly starting to hedge their bets a bit. But we've started to see flows return to the diversified global emerging markets funds, which is usually a first step when sentiment towards emerging markets is rallying. But of course, there's very little of 2025 left, so a certain amount of the flows for the next few weeks will be tactical and end of year. I think the bigger bets will start to come in the first month of 2026.
Yeah, if there's any reversal at all. But sometimes you never know. December can surprise, and it can really have more activity than you imagine. But Cameron, quickly to go back to your earlier point, right? It's South Korea, Japan, China. These markets have stolen India's thunder completely in 2025. We were joking about it the other day that can India be the anti-AI trade? When South Korea is down 4%, you want to have a little bit in India. So are you seeing any evidence of a shift away from these three markets specifically, China, South Korea, and Japan?
Korea has certainly emerged from the pack in the past month or so. In addition to an AI story, it also offers a bit of a reform one at the moment. But I would agree with your point that if one of a couple of things happens, India will be well positioned. One is that the AI story implodes completely. I don't actually see that happening, but India remains the preeminent defensive play within the emerging markets universe. And secondly, something like AI has two stages. There's the stage where everyone wants to buy the picks and shovels to dig the mine, and then there's the stage where you operate the mine and dispose of the products. And India, I think, is quite well positioned when AI becomes, as people hope, a sort of an established part of the sort of general economic puzzle. India has good history of sort of harnessing established business processes. The success of its back office industry being a good case in point. But that, I think, is next year's story. I think for the rest of the year, it'll just bump along somewhat in the channels we've seen recently.
All right, Cameron, we'll leave it there. Good speaking with you. Thank you very much for joining us, and really appreciate your time here on CNBC.
Not at all.
Thank you. Well, let me just quickly run you through the interactions lined up on the program. So coming up at 9 o'clock, we'll get you excerpts from a CNBC-TV18 exclusive. Kotak Mahindra Bank's founder and director Uday Kotak and managing director and CEO Ashok Vaswani speaks with my colleague Shireen Bhan. So excerpts are that conversation coming up. 9:20, Amish Shah of Bank of America Global Research is a market master of the day. That'll be an interesting chat. 9:30, we have the management of IRB Infrastructure who will join us to discuss their second quarter numbers. Sumit Jain of CLSA will be speaking with us from the sidelines of the CITIC CLSA India Forum 2025. And of course, IT is going to be in focus there. 9:50, Inox Wind Management speaks to us on the back of their second quarter earnings. Towards the end of the program, Lata in conversation with Timothy Moore of Goldman Sachs on why they've turned overweight on India. Stay tuned.
Welcome back. So even though cues across Asia are fairly red, the implied open is telling us that we'll start positive yet again. Positive momentum continuing from Friday. There you go. It's actually building now. It was 60 points when we last checked. Now it's about 70 points. So looking good and right up there. I mean, the question is whether the market, the Nifty, can actually take out 26,100. That's where the index has been getting stuck. That's a bit of a congestion zone. So we'll see. Anyhow, there's, of course, a long list of stocks to watch as well. So let's straight away get to it in our CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. We are getting the fag end of the results, so we'll wind that down. But Kotak Mahindra Bank is in news this morning. Gaurav, fill us in.
Kotak Mahindra Bank is in focus, and the reason being that 21st November is the date when board will consider stock split. Now, remember, last stock split we saw was in September 2010. So definitely after 15 years, we may see some stock split action happening in Kotak Mahindra Bank, and the current face value is around 5 rupees per share. Apart from that, let's also go back in time and see what happened in second quarter. We saw ROA was at 1.9% and ROE was at just 10%, which was a bit below its own FY25 numbers. So that is something which will keep the bank's performance, specifically the stock performance, on leash. Apart from that, we also have some triggers coming up like net interest margins, which management said will expand in second half. So definitely that is also something that will be considered in the stock performance. Apart from that, let's also not forget that there is some speculation that they are considering buying stake in IDBI Bank. In fact, while talking to us, management said that they look at every opportunity to see if it makes strategic and financial sense. So that is also something that will keep the stock in focus. But as of now, 21st November is the date where we will be watching out for Kotak Mahindra Bank and any action happening in the stock split.
Okay, all right. Keep an eye out on Kotak Mahindra Bank, and you're getting closer to your date as well, Gaurav. Thanks a lot for joining in and filling us in with that. Moving to Sudarshan, he's here to tell us about Tata Motors, the PV business. Still a little bit sticky, sir, under pressure?
That's correct. So it was the first quarter when Tata Motors passenger vehicle business has reported earnings as a standalone business. So standalone business is the India segment and for JLR, and earnings for both these segments are weak. Company has reported losses for both standalone and consolidated business. Worst part is JLR has revised its guidance lower. For EBIT margin, now it's expecting in the range of 0 to 2% versus earlier guidance of 5 to 7%. On the cash outflow front, it has increased the guidance to almost £2.5 billion from almost to zero. Now, if you talk about they had faced the cyber incidents attack, and because of this, in the consolidated business part, they have reported the impact of almost 2,010 crore. What's going forward? So for JLR, it's expecting Q3 also to be impacted of cyber incidents and normalcy to return only in Q4. For JLR, again, another weak quarter that we're expecting. For standalone business, company is saying that the growth for H2 FY26 will be in double digit. For FY26, growth is likely to be 5% plus and minus 2%, so almost in line with the industry. And also for the standalone business, going forward, new launches may improve new launches may aid the growth. So overall, just on the basis of Q2 earnings, I'm going with red.
Okay, all right, got it, Sudarshan. So indeed, a tough quarter at Tata Motors PV. Let's hop across to Vinny, find out how Siemens fared in Q2. Vinny?
Hi, so in the September ended quarter, the company's numbers, a mixed set of numbers that's come in. When you look at the revenue, that beat the analyst expectations, but in terms of the margins, that was below what the street was expecting. So let's look at the revenue growth, 16% growth in terms of revenue. Other income has seen a decline of 48%, while in terms of EBITDA margins also, we're seeing a compression coming in 11.93% versus 12.23%. So contraction in terms of EBITDA margin. Profits, yes, lower by 7%. But do not forget, last quarter obviously had that adjustment. So we are adjusting the profits of that number of Siemens Energy, that discontinued operations from Siemens. So that has taken place separately, and that is why that adjustment comes in for the PAT. But still, the PAT is impacted by lower other income as well as higher other expenses is impacting the profitability, and that's why the decline of 7%. Apart from that, the company has managed to see good growth in terms of orders as well, 10% growth there. And execution seems like that's improved in the smart infrastructure side of the business, mobility side of the business. That's seen an improvement because that side of the revenue has seen a growth. Digital industry side of the growth has remained soft. That is mainly weighed down by the low carry forward order backlog as well as muted private capex. That is still impacting the digital industry side of the business. And low voltage motors also has continued to face some bit of a headwind there. So that also has seen some pressure there. So overall mixed set of numbers, we could see slight bit of a green coming in here.
Okay, all right, Vinny, got it. Thanks very much. So green for Siemens perhaps today. Back to Sud then. Oil India, Sudarshan, what about this one?
It was an operationally weak quarter for Oil India. Bottom line has improved or risen or seen a sharp rise because of other income, which has increased to 830 crore versus 180 crore. Also, company has seen an increase in the tax write-back. It has reported tax write-back of 102 crore versus 21 crore. But if you take a look at EBITDA, it was down 17% and margin has fallen to 24.3% versus 32% that company had reported last quarter. Two of its major segments, that was crude oil, where margin has fallen almost 360 basis points, and natural gas margin has fallen more than 1,000 basis points. So I'm going with red for Oil India.
Okay, all right. Thanks a lot for that, sir. Well, let's go across to Ekta. She's here to tell us about Glenmark Pharma. That was actually seen delivery-based buying and long build-up. But those numbers are a little bit shocking. Ekta, tell us more.
Well, yes, it was a quarter of exceptional items this quarter for Glenmark. So while the reported revenue this quarter did have that one-time income of around 3,670 crores from AbbVie, the licensing deal that they had for ISB 2001, there was an exceptional outflow of 1,385 crores. Now, there were exceptional items mainly because of the India business, because of the GST changes. So the India business itself was down around 86% on a Q-on-Q basis, 87% on a year-on-year basis. There was a provision on certain inventories of 590 crores. There was 490 crores related to change in inventory model, etc. And there was an impairment of around 200 odd crores. So the adjusted revenue this quarter was around 2,380 odd crores, and adjusted for AbbVie, there was a net loss of around 900 crores according to analysts. There is a call at 8:30 a.m. this morning, so more details then. But North America was also higher by around 7.5% on an adjusted basis. So there was the big exceptional which came in from India, which really marred the numbers this time. But if you really want to see the AbbVie bulk of the income of the $700 million in terms of milestones is actually already been recognized this quarter.
You could call it, what do they call it? Sort of big bath accounting. So you throw in everything together. Right? I mean, it looks like one of those quarters. But, 8:30, as Ekta said, is the call. And we will have more on this, on that call as well, which I'm sure will come up. Well, Brainbee Solutions is the next one we're going to focus on. Mangalam is here with details on this one. Mangalam, morning.
Good morning. So, one would have liked the revenue growth to be a lot faster. The street was working with a number of anywhere between 20-25% sort of growth, keeping in line with the 3-year compounded growth that the company has reported. But at the same time, they've gone ahead and reported a 10% revenue growth. The EBITDA grew just shy, which meant that the margins kept at around that 3% mark itself. And this is a seasonally weak quarter, so the company continued to report a net loss of close to around 50 crores versus a loss of 62 crores. But remember, that's largely a cash reporting loss, because on the cash basis, they are profitable. A large part of the losses came in on account of the depreciation expense. Adjusted for share-based expenses, the company said the EBITDA actually grew 51% year-on-year. But it's not the EBITDA growth that the street will be disappointed by. More on the revenue side is something where the disappointment came. If you look at the India business, there too, the revenues grew by just about 8%. The international business, the revenues grew by 13%. And global bees, there too, the revenues grew by about 14%. For perspective, the last 3-year CAGR of the company in terms of revenue has been upwards of 40%. So in light of that, expect the stock to see some red today.
Okay, all right, got that. So that's Brainbees. Mangalam, thank you for that. Let's head back to Ekta. What about Max Healthcare and Narayana Hrudayalaya, the hospitals, Ekta? How did they fare?
Well, no complaints coming in, because Max, the revenue was up 21%, margins 26.9%. Profit up around 59%, which was aided by a favorable tax impact of around 149 crores. But the statistics look good. The EBITDA per bed was higher this quarter. The average revenue per occupied bed for Max was higher this quarter, and at least on a sequential basis. And we had the international patient revenue, which was higher by around 25% year-on-year and 11% Q-on-Q. So that metric has recovered for Max as well. For Narayana, good numbers, 20% growth in the terms of revenue. EBITDA is coming at around 26%, and the profit was up around 30% this quarter as well. So both the hospitals performed well this quarter.
Okay, all right. Thanks a lot for that, Ekta. Going back to Sud. Sud, what about Exide?
It was a very weak quarterly earnings from Exide Industries, and mainly because of the demand postponement that company had seen ahead of GST rate cuts, and also they had taken production cuts in the month of August and September. Look at the headline numbers. Profit has fallen 26%, revenue was down 2%, EBITDA has seen a fall of 18%, margin too has slipped lower to 9.5% versus 11.3%. So it was an all-round miss, but the good part is company is saying that growth will be coming back very strongly in quarter 3. But on the back of Q2 numbers, I'm going with red for this also.
Okay, all right. So thanks very much for that. Well, it's Exide for you. Inox Wind is the next one. Vivek is here with details. We speak with the management also, by the way, later. Vivek, take it away.
Well, that's right. So when we speak to the management, key to ask them would be whether they stick to the 1200 megawatt execution guidance. In the in the analyst call, post the result, they have indicated that they stick to it, indicating that H2 in terms of execution should be largely strong, and that may also imply that margins may moderate a little bit from the current upwards of 20% level. But still, we will need to check whether there could be an upward revision as far as the margin guidance is concerned. Now, talking about the numbers themselves, revenues higher by over 50%, EBITDA higher by 37.4%, EBITDA margins moderating on a year-on-year basis, but above the guided band of 18 to 19%, EBITDA margins at 20.3%, profitability higher by 42%, but remember, profitability number one was impacted by higher interest costs, and also there was a minority interest outflow of close to 29 crore. Second quarter order execution was at 202 megawatt, and the order book now stands in excess of 3.2 gigawatts, going with the green given the fact that in this particular quarter margins have been quite strong.
Okay. All right. Thanks for that, Vivek. And indeed, we will touch base with the management in a bit from now and get some more clarity. Here's a quick recap of the stocks to watch this morning. The ones that have positive news flow around them are Kotak Mahindra Bank, Siemens, Max Healthcare, Narayana Hrudayalaya and Inox Wind. Stocks with negative news flow around them would be Tata Motors PV, Oil India, Glenmark, Brainbee Solutions and Exide Industries. Okay, so that's the stock list for the day. Let's figure out what's happening in the world of commodities. We have Manisha joining in with a roundup of all the action. Manisha, morning. I remember reading apparently there was a drone attack on some Russian oil infrastructure in the Black Sea. Never a dull moment in the oil markets.
Oh, well, absolutely. It's been a very, very volatile last 10 days when you look at commodities. I mean, it's been the case for all of 2025 as well. But when you look at the crude oil prices, well, yes, the Russian refineries did see a shutdown caused by the Ukrainian drone strikes, and it was a 2-day shutdown. And the reason that you're looking at the crude oil prices declining in the Asian markets by more than 1 percentage point is that the Russians' Novorossiysk port has resumed oil loading operations after that 2-day shutdown. So we're looking at some pressure continuing for this one. The pressure also has continued for many of these metal prices. If you look at gold and silver, they have continued to decline as well. The markets are now assigning a 46% probability of a rate cut in the month of December. I mean, this is down by from nearly 85% that we saw before the previous US Fed meeting. So that is weighing onto the markets. Also, the dollar index has inched higher ahead of the U.S. economic data. Having said that, gold is still up 55% in this year. This is the strongest yearly gain since 1979 that we've seen for gold. The only other thing that has seen some great gains really has been the ferrous metal. So iron ore is trading in the positive, and so is the steel rebar futures trading at a 1-month highs in the Asian markets right now.
All right. Manisha, thank you very much for that. Well, that's basically a picture from commodities. Well, we'll take a quick commercial break here. We're going to come back. Dharmesh Kant of Chola Securities will be with us for some fundamental stock conversation. The Glen call should be getting underway, and we'll have some sort of flashes from what the management is saying on that one as well. Stay tuned. Coming back.
Welcome back. Hope you're having a good morning. Well, we've listed out all the stocks that we're looking at, and let's get some analysis going. Dharmesh Kant, Head of Research at Chola Securities, joins us on the show. Hi, Dharmesh. Fag end of earnings. Looks like you've had a good, relaxed weekend. But let's focus on a couple of numbers. Tata Motors, the PV business, came out with its set of numbers, looked weak. They have challenges for quarter 3 as well, particularly in JLR. What's the view on this one?
Yeah, good morning, Nigel. Thanks for having me for the show. The numbers were pretty weak and the guidance was equally weaker with, 2.5 billion pounds of cash outflow going forward doesn't augur well for at least for next 3-4 quarters. And if you look at the JLR numbers, it has come down from a run rate of 1 lakh plus to 66,000, and going forward it's likely to squeeze further. So all sets of worries are, plaguing the company. Earlier it was tariffs and then the cyber attack, and now the phase out of Jaguar also will have its, cost playing out into the P&L. So I think it's better give a skip unless you are a buyer for 2-3 years and then hoping that in 1 year time frame the dynamics stays with JLR business and it continues to pull it through. Otherwise, I think passenger vehicle business should be given a skip. However, if somebody wants to take a chance, maybe CV still gives you a better opportunity compared to PV business.
Okay, all right. Dharmesh, I wanted your view on Glenmark. And the con call is currently on, and those flashes are running on the screen. And they'll have to come out with a very, very good clarification for the last quarter's numbers, because they look absolutely very, very weak. And the bigger problem is positioning was heavy as well. What's your view on Glenmark as a stock? When they did that licensing deal, I recall the stock had gone to 2,200 rupees. It's at around 1,900 rupees. But if the clarification is not very good, the stock could be under pressure. Your view on the name?
Yeah, definitely, yes, Nigel. I mean, that day itself, the stock rallied around 20% kind of a circuit it was when the announcement came through, and most of the revenue booking has already been done through the licensing deal. So almost $560 million of revenue has been booked. Going forward, the run rate will come down to $35 million for this year, balance of the year, and next 2 years it would be around, in rupee terms, around $70 million, so $60 million, at 300 odd crores. So the timelines by which the drug would be rolled out, the development phase and the commercial, distribution phase, that is very critical. And the size of the market which the company is being for the American pie of the business, along with Europe, China and Greater Japan, and the India side of the business. So that will, be very critical for the price to sustain from here. Having said that, I don't think there would be a huge correction in the price, even if the clarity is not given this quarter. If the management wants to take a couple of quarters before committing on the timelines, the stock will, chug around. I don't see either ways big movement happening into the stock. India business was definitely weak. So let's see what they have to give a clarification on that.
Dharmesh, just a few, and Glenmark the call is on, as we've been saying, and we're putting out some lines from there. Just a couple of names, Dharmesh. If you want, Grow was, it's $150 now, right? If you have a comment there. Muthoot Finance was up 10%, so that was a big mover from Friday. And of course, all these defense stocks have started to make a comeback once again. There was specific news flow for BDL, but results basically. But defense index ended about 1% higher. So if you have any thoughts, Grow, Muthoot and defense.
Yeah, good morning, Prashant. As far as Grow is concerned, I will give it a skip, being a competitor. But yeah, they are the number one players and they are commanding a huge premium out there compared to the others in the basket. But we are not very, bullish on the intermediaries or the brokers per se. But we are bullish on the other capital marketplace, which includes infra and AMC. So that's the reason why we have given it a skip. It's getting a retail traction, which is likely to continue here. Muthoot Finance is in a sweet spot. The management, the kind of guidance upgrade they have given, I haven't heard that kind of a guidance upgrade from the management in the last 5-6 years. So it's a very bold step by them, and they are conservative management. So I think they are likely to deliver on that. Gold Finance per se has been doing particularly well for all the NBFC. So that is likely to be there. Defense, Prashant, we have always been a buyer in any declines, and I think a structural growth story in the making. And the type of order books is getting swelling. BDL, you took the name. Look at the type of order book. They are sitting on 23,000 odd crores, so almost 5-6 times the revenue visibility. Same is the case with HAN and BEL. So these companies, one should be, buying on declines, and it should be a portfolio buy for at least 4 or 5 years. Because as time progresses, your 64% kind of a value addition will happen in India, and that will take care of the margins on the higher trajectory side. So the topics out there remains HL, BL. These are the two counters we are sticking our neck to.
Okay. All right, Dharmesh, stay on. We'll have some more stocks to discuss with you in a bit. Need to take a very quick break. Come back on the other side, and we'll have some interesting nuggets in terms of delivery, some stocks that were very active and interesting delivery trends that have come out, and then, of course, technical trades with Sudarshan Sukhani and Mitesh Thakkar also coming right up.
Okay, well, let's quickly go across to Hormuz now, who is standing by with the big movers and shakers on Friday. And I'm sure Muthoot, Grow, etc. perhaps find a mention there. Hormuz, morning.
Morning, Prashant. Muthoot does find a mention, but the bigger outperformer on Friday was Ipca Laboratories. There's some positive commentary coming in from the management call from after its results. The stock was up almost 14%, the top gainer among the Nifty 500 names. The volumes on Friday were 8x of those on Thursday after the results were reported, and almost 41 lakh shares traded. The 20-day average is only 1.5 lakh. And out of those 41 lakh shares, 6.5 lakh shares were marked for delivery compared to the 20-day average of less than 75,000 shares. So delivery-based buying on strong volumes as well for Ipca Laboratories. The stock is still down 14% though on a year-to-date basis. Now, Muthoot Finance ended at a record high on Friday, and it's been moving. It's been gaining in 5 out of the last 6 trading sessions. The stock had close to 50 lakh shares traded. The 20-day average was just 5.5 lakh. And out of those 50 lakh shares, close to 7 lakh shares were marked for delivery. The 20-day average here is 2.5 lakh shares, and it's been an outperformer this year. It's up almost 70% on a year-to-date basis. On the downside, though, All Cargo Terminals was the top loser on the BSE small cap on Friday, down around about 10%. And this was after it had a 3-day gaining streak, and it has given up almost all of those gains that it had 3 days prior. And the second straight session of more than 15 lakh shares that were traded in a single trading session happened on Thursday, happened on Friday as well. The 20-day average was only 5.5 lakh shares, and out of those 15 lakh shares, close to 10 lakh shares were marked for delivery, and here the 20-day average was only 2.5 lakh shares. Lastly, GE Power was another earnings reaction on Friday. It was the 4th straight day of gains for the stock. Had a similar move back in August as well on very strong volumes. And here too, with close to 45 lakh shares traded, the 20-day average is less than 1 lakh. And out of those 45 lakh shares, 7 lakh shares were marked for delivery. And here the 20-day average is less than 50,000 shares.
Thanks a lot, Hormuz, for that. Well, let's hop across to Sudarshan, who is back with us to tell us a couple of brokerage calls. So take it away.
So I have 2 brokerage calls today. Jeffrey has returned Torrent Power. It has initiated coverage with a buy call, and target here is 1485. It's saying that it's a unique company amongst listed Indian power utilities, which sees steady growth, high ROE, and relatively low debt levels. 60% of its EBITDA comes from distribution and rising at a steady rate of 8% CAGR, while 40% of EBITDA comes from generation, which is expected to rise at a CAGR of 13% over FY26 and 30. Citi has returned Ajax Engineering. It has upgraded the stock to buy from neutral, and target is 735. It says Q2 EBITDA came in at rupees 45 crore against its expectation of around rupees 35 crore. Margin, though, has seen a contraction to 10.2% versus 13.2%, and mainly because of first transition costs to new CEV5 emission norms, and they have seen changes in the product mix that also impacted the margin. But in H2 FY26, because of operating leverage and efficiency measures, they see the profit to improve significantly, and that's the reason it has upgraded the stock.
Okay, all right. Thanks a lot for that, Sud. Well, Dharmesh, coming back across to you, a couple of other big movers that we have seen in the last few trading sessions. One is Amber. They've gone ahead and they've strengthened their presence in the PCB segment. They've done some inorganic growth via one of their subsidiaries. The acquisition revenue is just 390 crores or thereabouts. But, it could be strategically important. Any view on Amber Enterprises?
Yeah, Nigel, I think, this is a small acquisition, and the last quarter numbers were, very dismal set of numbers. And so was the case with all of the REC players in the segment. So I think as the season unfolds for second half, this is not a good season for companies like Amber, but the other part of the business, PCB, we have to see how it pans out. So the valuation wise also it's expensive. It's not very cheap, so that you can jump and buy it. The advice would be to wait for one more quarter. Let's see how Q3 pans out, number pans out, and then if the traction is picking up, one can go and buy it. Just because the valuations are pretty expensive, we are giving it a avoid as of now.
Yeah, no, absolutely. And I think it's a fair point that you make, Dharmesh. Just maybe a quick look at some other names. By the way, broader markets were under a fair bit of focus as well. Although, actually market breadth was a little negative on Friday. Volumes completely with of course what was up and about. There's this company which listed recently, ignored after listing immediately. It's not very, I mean, I think about 30 days old in listed space. Rubicon Research. Did you have coverage on this one, Dharmesh?
No, sorry, Prashant, we did not cover it. Yeah.
I see. I got that. Jubilant Food, Dharmesh, any thoughts? Saw that big move on Friday.
Yeah, definitely. I mean, in the QSR space, this was an outlier when they reported the numbers, and a good traction was found there, both in the same store sales growth as well as the new stores that they have been, making more inroads into the country. Valuations are, I mean, higher, but that has been the case historically. But if somebody wants to be into the QSR space, I think this is the only counter where the economies of scale and unit economics is working very, fine with them, because they are not asset heavy or the restaurant heavy kind of a business. Others who have tried to do that, the cash burn has been far higher, or the capital deployment has been far higher than the revenue being generated. So for QSR players, if you want to be in the space, I think Jubilant FoodWorks is the top pick out there.
Jubilant Food is the top pick out there in the QSR space.
Yes.
Got that. Dharmesh, stay with us. What we're going to do is take another quick commercial break here. We'll come back. We'll get you some technical trading ideas as well on the other side. And also excerpts of a CNBC-TV18 exclusive with Kotak Mahindra Bank's founder and director Uday Kotak and MD and CEO Ashok Vaswani coming up in just a bit.
Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. As promised, let's get in our technical experts. We have Sudarshan Sukhani of Technical Trends and Mitesh Thakkar of Bonanza Portfolio, who join us on the show. Good morning, gentlemen. Good to see you in. Sudarshan, you go first. What's your take? We had a bit of a surge in the last hour of trade on Friday, but still it appears the market's in a bit of a range. For starters, how would you trade the Nifty?
Yeah, good morning. See, on Thursday, I had suggested that we should stay away till the Bihar election results come, because we will see volatility, and that is now behind us. So irrespective of what the world markets do, I think at least for today, the trade is to be on the long side of the market, enter the market, buy. Now, whether you want to buy at the open or on some kind of a minor dip is a different matter. It's a question of tactics. But eventually today, by midday, you should be long in this market. I wouldn't worry about what the world markets are doing. I think India will now chart its own course for the next 2 months or so, and that will be pretty bullish.
Yeah. So for now, the idea is to be on the long side. Gentlemen, morning. Good to have both of you here. Mitesh, what about you? How would you think about trade from here?
Good morning, Prashant. So, I also maintain a positive bias, saying that if we don't see a closing below 25,800, 750 zones, and we did actually decline just below that on an intraday basis on Friday, I think we are likely to head back to about 26,100. So I think that movement still looks like a very good possibility. Beyond that, 26,270, 280, which is the all-time highs, could be revisited. So the overall bias is on the long side. A good entry point will always be close to about 25,800. But even if somebody wants to enter afresh today, I think try and take some profits of around 26,100 and then see, if it manages to get past those levels, the index, and then we'll head towards the all-time highs.
Yeah, got that. Sudarshan, what about individual trades? What's on your list?
Well, it's an all-buy list. JSW Energy is a buy with a stop under 520. Dr. Reddy's is a buying opportunity with a stop under 3,000. IGL is a buy with a stop under 210. And finally, after a long time, L&T is coming in my list. L&T is a buy with a stop under 39.25.
Got that. Mitesh, what about you?
I also have an all-buy list. HDFC Life is a buy with a stop at 762 for price targets of around 795 to about 800. A buy on Godrej Consumer with a stop at 1130 or just below it, and a first target of 1180. Couple of banking names. Bank of Baroda is a buy with a stop at 281.5. Look for targets of around 296 to about 298. And Axis Bank is a buy. Keep a very tight stop at 1226. Look for a target of 1275.
Yeah. Muthoot on that list, Mitesh? Sorry. No. Oh, you have a trade running?
No, Muthu, see, the only reason today I would not suggest an entry because of the big risk reward. So now the stop loss will be slightly much deeper. So from a trading point of view, not the best entry point, but the chart structure looks very positive. In case you get a dip close to about 3,600, would be very happy to add it on the long side.
Yeah. Got that. Fair enough. I think what we'll do is, thank both of you, Mitesh and Sudarshan. Thanks for those trades. Thanks for that view, and talk to you soon again. And now, with about, a minute to go for the pre-open session to kick off, let's just quickly get you the exclusive we were talking about. So this is a CNBC-TV18 exclusive. We welcome foreign investment as long as rules are consistent for similar institutions. That's the word which came in from Uday Kotak, founder and director of Kotak Mahindra Bank. This in a conversation with my colleague Shireen Bhan on inorganic strategy. Now, Kotak Bank's MD and CEO Ashok Vaswani also was part of the conversation. He said they're looking at every opportunity to see if it makes strategic and financial sense. Listen in.
What we're seeing happen in the banking sector, it certainly seems to be the flavor of the season as far as FDI is concerned. Large deals happening from IDFC Bank to RBL to Yes Bank to Federal Bank as well. Mr. Kotak, what do you make of this? I know you tweeted saying that it's a welcome sign, but you hope that it will create a level playing field. What do you make of this?
I think, Shireen, first you have to distinguish between private equity and strategic. So out of the deals you mentioned, there are two strategic deals.
Yes.
One is SMBC into Yes Bank, and the second is Emirates NBD into RBL. That is very different from
BlackRock
and Warburg into IDFC and Federal Bank. Those are financial investors at the core. Maybe they are playing for some strategic to buy those banks in the future. So who knows? They're in the business of producing financial returns. The strategics are taking a long-term commitment into India. And frankly, I would welcome it as long as we have consistent rules for similar financial institutions across the board.
Because at this point in time, it's case by case. But the fact that we're now looking at the regulator giving the go-ahead to control deals, what does that signal as far as the willingness of the authorities on this front?
I'm glad that India is feeling more secure and bold. We saw competition come into investment banks where majority was allowed in early 2000s. You saw it in securities, asset management, life insurance. So banking was the last bastion, and I'm glad that the policymakers are confident that Indian financial sector can withstand the onslaught of global FDI and still maintain the ability to remain truly Indian and become world class.
You know, a strategic investor in Kotak Mahindra Bank, you don't need it, but is that even up for consideration?
Last time I saw the cap table, that strategic investor was Uday Kotak.
So not on the table.
Certainly not.
But how do you see it from an operations point of view? Two strategic deals being done, private equity interests. What does it change anything in the marketplace?
It's actually quite fascinating, Shireen. On the one hand, yes, we talk about, obviously, there's kind of covered the deals that have happened. On the flip side, we've had foreigners also leave. I mean, Citi sold its consumer franchise. Deutsche has put up its business for sale. We bought the Standard Chartered personal loan portfolio. And so it's just an interesting kind of phenomena. Let's see how it kind of plays out. Honestly, competition is welcome. It keeps us on our toes. And we just got to get smarter, better, and move faster ahead. And that's our goal.
Smarter, better, bigger. And I'll ask you this in the context of IDBI Bank, which, it's been 10 years now since ING Vysya. The question is whether you still have the appetite to do IDBI Bank. I know you continue to be in the frame, Mr. Vaswani. So let me direct that question to you first before I get a broad picture there from Mr. Kotak. IDBI Bank, how serious is Kotak's ambition there?
So we've had this conversation before.
Yeah.
Look, we look at every single opportunity there is. Obviously, our goal is to transform for scale. So we look at it. If it makes strategic sense, then we go to the valuation and see whether financially it kind of makes sense. And if it makes sense, yes. Also, you got to say that we are on a certain path, right? We're on a certain path, transformation, or they talked about the changes in financial services, how technology is changing a whole bunch of stuff. And therefore, what is our priorities? What is our management mandate? Where are we going to really spend our time? Is it going to be spending time in integrating HR and payroll systems, or is it going to be really transforming the business? So those we kind of take into balance and see whether a thing makes sense.
Okay, so that's Mr. Uday Kotak saying that last time he checked the league tables, Kotak Mahindra Bank itself was a strategic investor, referring to, of course, the big moves they did with ING Vysya in 2015 and a spate of other smaller deals they've done in the BFSI space. Mr. Ashok Vaswani also says that the bank wants to become the third largest, most profitable private sector financial services group in the country. He also is ruling out unlocking value in any of the businesses by way of listing, at least as of now.
Speaking of that journey, and you just unveiled this One Kotak sort of campaign and One Kotak ambition that you've put out there as far as customers are concerned. How should investors read that from an unlock and a monetization perspective? Could we potentially look at some of your businesses being unlocked, being monetized in the near future, or is that not a consideration at this point in time?
So Shirin, think about it. Kotak is the broadest financial conglomerate in the country. There's nothing that's like the Kotak financial conglomerate. This conglomerate allows us to take advantage of whatever changes may be happening in the financial services sector, whether it's in saver to investor, whether it's corporates going from bank balance sheets to corporate bonds, capital markets. We can serve these customers across the group. That is the power of this group. This also allows us to identify customer segments that we want to really go after, bring together products and services relevant to them, and build out propositions. And where we've done that, we've got really, really good results, whether it's with the private bank, our recently launched Solitaire program, our 811 program, the SME segment, or institutional clients for that matter. That is the power of Kotak, of being able to bring together and meet the holistic needs of the customer. That embedded value is growing. Why would we monetize it early?
No, early, but at some point you will? Or intend to?
Right now, very early. We'll see what the future holds. But frankly, I honestly don't see the value of monetizing it right away.
At this point in time, I ask you this also in the context of what you're seeing happening around you. I mean, things like the Grow listing, an 8-year-old company listing in the manner in which it does that kind of tempt you to look at what's happening in the market?
Not at all. The embedded value of Kotak is growing at a compounded rate. And there really is no reason for us to kind of list at this point in time.
So no departure from that
no departure.
Mr. Kotak, an overarching view on this aspect, because I'm sure that this is something that you discuss and debate very often at the board level.
Shirin, I think the financial intermediation space is undergoing transformation. One is thanks to technology. Second is the move from saver to investor. Third is the flexibility across the intermediation space, which is expected by customers. And therefore, to create inherent disparities between different segments is inconsistent with the best way to serve customers. Therefore, think about yourself. You may be a saver and an investor in one. Therefore, as a financial intermediary, we cannot think about ourselves as a bank or asset management company or as a broker. We've got to think about wherever the intermediation moves, the group is there to serve you. And therefore, if that is the basis, the theme about One Kotak is an extremely powerful theme where the newcomers rightly start with a vertical, but ultimately the challenge is how do you serve your customer in totality?
Okay, that is Mr. Uday Kotak and Mr. Vaswani on the strategy and the road ahead for Kotak Mahindra Bank as they look to become the third largest private sector BFSI conglomerate in the country. Kotak Mahindra Bank up about 0.7% right now. In fact, that brings us to the overall pre-open. It's settled now. The gain is a little more measured, 38 points, not as much as what the implied open was indicating. A couple of stocks that stand out on the back of earnings or announcements. Idea Forge, by the way, has got itself an order. That's why that stock is flying up about 7%. V2 Retail, IRB Infra, Narayana Hridayalaya. These are all stocks that are reacting very positively to earnings on the upside. Glenmark, with so many exceptionals and extraordinary items in the numbers this time around, is down about 2% as we speak. That's what we have. Okay, let's quickly get to our experts then for some final trading calls. Darshan, which stock will you go with?
It's the JSW Energy. Buy with a stop under 520.
Okay, and Mitesh, your stock?
I'll go with a buy on Godrej Consumer for targets of around 1180.
Okay. All right, gentlemen, thanks very much for that. Let's stick with more reactions and let's look at what Siemens is doing. Siemens is, well, flat. Numbers have been fairly on track. In fact, let's bring Vinny back in. I think we have Vinny with us. Vinny, fill us in on Siemens once again and what the street view is.
So when you look at Siemens number, it's a mixed set of numbers, right? Revenue, that was a beat that came in from what the street was expecting versus in terms of margins, that was a miss. And that is why, you're not seeing much of an excitement coming in the stock, whether on the upside or the downside right now. Mainly revenue growth, 16% growth in terms of revenue. On the flip side, other income, that's down by 48%. EBITDA margins, they've come in at 11.93% versus 12.23%, which is a contraction in terms of margins. And profits of the company that have seen a slight bit of a decline of 7%. This is the adjusted profit I'm talking about, because in the base quarter, there were some one-off adjustments because of Siemens Energy. And that is why last year's profit, you cannot compare it on a like-to-like basis. So that's why that adjustment there. Now, obviously, apart from that, what's impacting the profits is other expenses were higher and other income was lower. So that is why the profit is a bit muted. Growth in this quarter, when you look at it, that was mainly driven by execution that came in from the smart infra side of the business as well as mobility business, which grew by 28% in terms of mobility business and smart infra by 20%. Digital industries, that remains soft. So again, another segment which is not done well for the company. And low voltage motors, that also continue to face headwinds. So two segments did well, two didn't do well. And that is why mixed is what we're calling in terms of earnings. But Nomura has upgraded the stock and they have upgraded it to a neutral rating. So that is what we'll be keeping an eye on. The target price they've given is 3,325. Watch out for Siemens.
Okay, all right. Thanks a lot for that, Vinny. Well, the stock is opening up more or less flattish. Well, let's get in Mitesh back. Mitesh, just a quick word on Glenmark. The numbers didn't look good at all, but it seems the street is not too disappointed with the con call because the stock has opened up only 2%. Going by those numbers, it could have been down far more. Technically, how's it looking?
Nigel, I think, I've traded the stock last week, so there was interest. But I'll tell you something, the pattern, if you look at the price chart, 27th of October, we got a closing of around 1812, and then 6th of November, it was 1810. So typically, could be a double bottom formation. The breakout happens once the stock price moves above 1920, 1930. So I think with today's opening, it may not happen, but that is the key reversal level. Once we see these bad numbers are being absorbed and the price still moves up and gets past 1925-30 zones, then I would be very interested for a target of at least 2010 to 2020 and maybe more.
Okay, all right, got that. Let's get back to Sud and look at Tata Motors PV. Maybe we can get the stock up as well because it's been quite a, I could say a bit of a car crash kind of a quarter. This is the passenger vehicles business for Tata Motors. That was just a pun. Please don't take it too seriously. But Sud, yeah, the numbers were really disappointing, weren't they?
It's a forgettable quarter for the company because it has reported losses for both standalone and consolidated business. And one of the main reasons is the cyber attack that JLR has faced. And because of that, in the consolidated segment, company has reported an impact of more than rupees 2,000 crore. As far as the outlook is concerned, JLR has revised its EBIT margin guidance lower to 0 to 2% from earlier target of 5 to 7% and has increased cash outflow guidance to £2.5 billion from the earlier target of almost zero. Now, what's going forward? So for standalone business, new launches, company is saying that it's going to aid the growth. And for H2 FY26, industry outlook seen in double digits. And for FY26, the growth is seen at 5% plus minus 2%. For JLR, Q3 is also going to be weak. Company is saying that normalcy will return only in Q4. As far as brokerage are concerned, Jefferies maintains underperform call and target has given is of 300. GS maintains neutral call and target is 365. On the other side, CLSA maintains outperform call and target is 450.
All right, so thanks very much for that. Stocks down about, 3% at this point in time. Just want to quickly run you through the, stocks apart from this one that we've covered from the morning as part of our top 10 and otherwise. So Kotak Mahindra Bank, of course, starting about 0.75% higher. We've got Siemens, which is starting about a third higher. Max Healthcare is up, but small up. Narayana Hrudayalaya will come up on your screen. That's a strong move, 1800 plus now, 5%. Inox Wind, you'll hear from the management later, 1.25% in the green. Tata Motors Passenger Vehicles Business, Surge's outline. Oil India is flat. Glenmark is down, down 2%, but that's it. And Brainbee, Exide, of course, is basically a miss. But again, down only about 1% or so. So largely pretty small kind of changes coming through across the board without very much in terms of large moves. By this time on Friday, if you remember, Muthoot, etc., were all jumping up 8-10%. Maybe just look at Grow, if you will, if you want to put out in the pre-open session where that is starting out at. And then we will just do the countdown. 4% higher, 4% more. 154 on Grow. So that is what's coming through. About 40 points up on the Nifty. The sensex, of course, up as well. The rupee starting slightly stronger, 88.71 compared to 88.74 at this stage. First rates coming up on the Nifty and the Nifty Bank, sensex, etc. And then we look at individual stocks. That's the opening bell this Monday morning. And 25,940 is the first tick. 58,500 is on the Nifty Bank. So it's 20 and 90 on the Nifty Sensex respectively. And the Nifty Bank is starting up as well, about 1/3% higher. So Nifty Bank, at least with the word go, doing better than what the Nifty is doing. 1,200 stocks are higher and about 780 stocks are lower at this point. Mid-cap index is up 1/3%. The Nifty heat map comes up on your screen, and we'll do a quick check in terms of where stocks are opening before we go any further. So just, where stuff is landing this morning. Bajaj Auto, Apollo Hospital. So it's, largely higher at this point. Tata Motors Passenger Vehicle and Eternal and HDFC Life on the other end. So that's the open. It's neither here nor there. It's about 10 points, 12 points. I'm sure specific stocks in the broader market more interesting open. Surabhi.
Yeah, absolutely. And there's so many names out there like V2 Retail, IRB. A lot of positive result reactions, by the way, this morning. And we'll talk more about them as we go forward. But on the Nifty, things are very, very quiet. Just 6-7 points up. So the Nifty is not able to start with a bang. Let's see what's happening at individual stock level. Bajaj Auto, Kotak Mahindra Bank. Of course, you just heard lots of the commentary there from Mr. Uday Kotak and Mr. Baswani. That stock's up almost 1%. Bajaj Auto, Tata Consumer, these are some of the other names. There's Titan as well on the upside. There's some buying on ITC, but then it just completely fizzles out. The banks have a bit of a positive bias, but no major moves. So SBI, ICICI Bank, they're all up 0.2, 0.3%. Kotak actually is the best of the lot, at least at this point in time. On the downside, Tata Motors, PV, those numbers are looking so disappointing, and it's not just about this quarter. The company's cut its outlook on the EBITDA front as well going forward. They've called out challenges in big markets for JLR like China and the US, and the street just was not prepared for this. 6% down on Tata Motors PV. Okay, beyond that, there is no major headline grabber on the index. Other stocks that are down include an Eternal, Max Healthcare, Interglobe Aviation. That's it. Some total change of just 5 to 6 points in the Nifty. Nigel.
Well, that's right. A few stocks, though, that are bouncing around in trade. You have transformers and rectifiers. The stock had seen a sharp correction after being barred by the World Bank. There was relief that came in from the World Bank on Friday. The stock, I recall, was up 10%. Today, it's seeing some follow-through buying. So that's up close to around 5% as we speak. Good up move is what you're seeing. Glenmark, well, the stock actually has gotten away with a cut of only around 2%. The street is bought into that guidance that the management has given. Now it's down close to around 3% actually. So it's trended a little bit lower. It's around that 20 DMA, which is an important mark. But the numbers were disappointing. The commentary seems to have some promise. We'll try to get you more on that particular one. SP Apparel, that's another stock from the broader markets, is bursting away. Volume's fairly decent as well. I guess they would have come out with numbers. So that one is up close to around 7%. Narayana, that's another stock that's opened up. Gap up, solid gains out there. Big volumes as well out there. 5.5% higher on that name. And Idea Forge, I think I just spoke about it. That stock, in fact, has opened up with a good amount of gains. That order win is boosted sentiment out there. So that explains why that stock, in fact, is flying away in today's trading session. And Gabriel India, from the broader markets. That's one of the losers. It's down close to around 5%. Not a stock we talk about very often, but that's coming for some profit taking, as is the case with Ashoka Buildcon. Both of them lower in trade.
Okay, I think so. It's a pretty good start. 2:1 is the advance to decline ratio, and the number one volume-led gainer on the NSE is Grow, which is up another 5%. So yeah, it's a profitable business, a very profitable business, a market leader, and from the opening, it listed it's 4 days old, right? I mean, it opened at 112, and it's at 155 at this point. So there you go.
And the market cap, because I keep tracking if it's how closer is it to the 1 lakh crore? Not yet. We are talking 95,369 crores to be precise. That's this morning.
Yeah, so there it goes. So Glenmark is down 4 now, 1821. It's got large volumes on it right now. So call, I think, is still going on. Until about 9 o'clock, there was still the opening presentations, and I guess they would have opened it up to questions from analysts, etc. Garden Reach is up 2%. Pine Labs is up another 3%. Pine Labs, of course, I mean, I think just 2 days, a day old, listed at about 242. And stocks at about 258, 260 now. Idea is starting about 1% higher. It's holding but large volumes. Transformers, I think Nigel mentioned 6%. So it crashed, and Friday was a big recovery day, and today it's continuing some of that move. Narayana, 6%. That's it. I mean, that's largely the bulk of what we're seeing across the board with what's coming up. Idea Forge, I think we mentioned, Ahluwalia Contractors, and Universal Cables is up 5.5%. Uniparts is up 10%. So, some of these smaller names are shooting up as we speak. So we'll come back to some of this. Silver Bs I can spot. Some of them are down about 3-4%. So precious metals on Friday, if you look at gold, silver, etc., saw a little bit of liquidation. So, I mean, all the listed ETFs are down between 3 and 4% this morning, and they're coming up with volumes as well. Well, let's welcome in our next voice on the show. Amish Shah is Head of India Research, Bank of America Global Research. He's in our studios to take the conversation forward. Amish, welcome back. Thank you very much for joining us here.
Pleasure.
So, it's been a while, it's almost 6 months, right, since we've last...
At your studios. We interacted over
August.
Virtually, yes.
Yeah. How's the view changed? How's it kind of evolved now? Where do we stand? I mean, we're also ending this year, looking into the new one. What's the view overall?
So, Prashant, I think the good news is that a large part of the earnings downgrades are now behind us. So, if you look at the numbers year to date, FY26 earnings have been cut by 10 percentage points. FY27 is cut by 7 percentage points. And as a result, consensus is now expecting only 8% earnings growth for Nifty for F26, and then 15%, very close to our numbers. We had a big gap earlier. That gap has meaningfully shrunk. As a matter of fact, despite the fact that second quarter earnings were positive, consensus has still cut estimates this quarter, right? And so as a result, I think the earnings cuts are now behind, which is always a good news for the market. The other thing is that the trajectory of earnings growth is now going to improve. So you had FY25 at 5.5%. The first half has been 8.6. We think second half is going to be close to 9. And then FY27 we think will be 13. So the growth trajectory is...
This is all Nifty 50?
This is all Nifty 50. So the growth trajectory is actually improving. Valuation on the other side, I would argue, has still not corrected, because while it might seem that the markets have gone nowhere or slightly over the last 1 year, markets are slightly down. The problem is that, the valuations obviously in September, when the markets peaked last year, were high to begin with. Since then, markets have gone up by 9.6% year to date. Earnings have gone up by 9, as I was mentioning. So earnings have actually just kept pace with the market performance. Valuations have just been where they were when the markets were seeming expensive last year. So I think incrementally, the way I think about it, difficult to justify a valuation expansion, but market performance will be driven by earnings growth, which, as I was arguing, is going to be on an upward trajectory now.
So that's the tricky part, Amish, isn't it? Because it's been such a polarized year. And you're right, at the index level, you'll say, okay, market has been flat. Even on the Nifty 50, you have stocks which have rallied, 40, 50%. Something like a Maruti or, Bajaj Finance, etc. And you have stocks that have fallen 40, 50%. Tata Motors and, a couple of others. So it's been very polarized. Now, when we try and apply this valuation and earnings turnaround argument and try and find areas where there is growth, which is at, if not a reasonable, but at least not an exorbitant price, do you see such pockets somewhere at the end of this year?
So we do, and I think that dichotomy is still likely to continue. So let's say when you talk about mass consumption categories like staples, footwear, apparels, etc., we think the growth is going to be a shallow recovery. Similarly, when we talk about capex, we think that the growth is going to be quite shallow recovery. So there will be disappointments. But the moment you turn to rate sensitives, because we do think that RBI will keep cutting rates, so rate sensitives like real estate, REITs, the regulated power utilities, financials, those will do well. Within consumer, we think consumer discretionary will do well. And a wide variety of consumer discretionary will do well. So I think there will be categories like rate sensitives and discretionary that does well. On the other hand, you will have pockets of capex and mass consumption that will be laggards.
But to complete the argument, I mean, has that already been captured in the price? Like I said, rate sensitive, you're saying. Just taking an example, Bajaj Finance, it's rallied 50% this year. So if you look at the rate sensitive universe, where you see growth, do the valuations support a fresh buy?
Yes. So I think by and large, financials as a pack, still is not expensive. For the last couple of years, I'm sure that, every guest who must be on your show must be arguing that financials is the only sector that screens out cheaper.
Yeah.
It still does.
Yeah.
And as a matter of fact, after 2 consecutive years of earnings downgrades, now it looks like there is an earnings upgrade cycle coming in for financials. Over and above that, the regulations for financial sector is now improving. We've seen that in the last RBI policy meeting. Plus, beyond that, now we are seeing the foreigners buying stake into mid-sized banks, etc. So all these regulations are also now quite supportive for the growth within the financial space. So by and large, I would argue that despite the rally, financials as a pack overall, whether you look at NBFCs or banks or SOE banks or mid-sized banks, everything still looks quite attractive to us.
All right. Hi, Amish, and good to have you in the studio as always. Tell us about the recent elections. The NDA coming out trumps in Bihar. The market would be thumping the table and saying this is what we wanted. However, if you look at it closely, the kind of cash that's being doled out, that'll put pressure on, say, a state like Bihar, that as it is, the deficit number is very, very high. And now you will have this cash that will be doled out, which will be higher than the capex. It could be restricted to, the state, which is the hope. But, you'll have more number of elections and it could be a contagion effect. How worried are you about this? Because all this money that's being doled out will have to be recovered from somewhere else. Case in point being West Bengal. Alcohol tax is going to go up from December 1st. How worried are you about these freebies suddenly coming to the system, capex on a bit of a back burner?
So, Nigel, very rightly, as you put it, so there is always going to be a trade-off because the resources are limited.
Yeah.
And on one hand, you want to stimulate consumption. The other hand, you don't want to let go capex.
Right.
But to your point, if you give money to one, money has to be taken out from somewhere else.
Yes.
So I think there will be a trade-off between capex and consumption. In the bargain, right now, it looks like that consumption will win, capex will lose out. So to add some numbers to the question that you asked, in FY24, which is 2 years back, we had a center plus state governments put together give out a total of $90 billion in subsidies.
Okay.
Right? Over a 2-year period, not just through subsidies, but through subsidies plus tax cuts plus RBI rate cuts, we've added $60 billion more to the consumption stimulus. So 90 has already become 150.
Yes.
And then if I fast forward one more year, with the pay commission hike and further RBI rate cuts, we think that will be another $40-50 billion that will get added to the consumption stimulus. So 90 over a 3-year period will become 200, right? And obviously, to your point, therefore, that if consumption stimulus is going from 90 to 200, that has to be taken away from somewhere, which unfortunately is capex. So that is part of our reason why I was arguing that capex growth will come off. Secondly, if you think about it, we all know that large part of the capex growth in India is driven by government.
Yes.
And over the last 5 consecutive years, government has been on the path of fiscal consolidation. But with the pay commission hike, possibly with the Finance Commission report that is due by the end of this month, there's a possibility that even if the government does not consolidate fiscal next year, there is just no more money left to accelerate capex meaningfully.
Right.
So we'll be lucky if we have 10-11% kind of growth continue for capex. If the government wants to consolidate further, then even 10-11% for capex will be a challenge.
Got it. And just to revise on the Nifty, I think the last time we spoke, the target was 25,000 odd. It continues to remain around 25,000?
Absolutely. So for this calendar, our target was 25. It still is.
Pretty good.
And we were arguing that, if there are 2 or 3 factors that play out in India's favor, which is a trade deal conclusion, which is not concluded, but, there is more clarity on it now because India has cut down on Russian crude. So at least that 50 should come down to 25. If there is more visibility of RBI rate cuts, which I think also has improved, then we were arguing that 25 can go to 26. So I think between 25 to 26, till the time these positive factors stay, is the target for this calendar. And thereafter, as I was arguing, that valuation multiples stay the same.
Yeah.
Market compounds in line with earnings growth.
Just one more word, we discussed a few sectors, but tech we didn't discuss. And the last time around, we were chatting about how it's under-owned and,
Yes.
Interest is very lower as well.
Yes.
How are you positioned right now out there? Because that's been the big under-owned sector. It's underperformed as well, with good reason for the kind of growth rates that you're seeing. But now there is optimism. There is some kind of attention being put to AI. Hopefully growth picks up as well. And hopefully some of those headwinds are behind. How are you approaching that sector?
So, Nigel, IT we are looking at very bottom-up because, let me put it this way, that earnings downgrades even for IT is now over. But if you look at the large-cap IT companies, they are all expecting revenue growth of mid-single digits, which A is not exciting, and B, there is no visibility on whether these numbers will get upgraded further. In the context of 5-6% kind of revenue growth, valuations, especially with the risk of AI as a debate still out there, is not necessarily cheap. But then there will be some companies that we like on a bottom-up basis. So IT is more nuanced bottom-up. By and large, as a sector, if I have to say, I would say we are more neutral weightish.
By the way, with that, there was India, US, there was a flash oil minister saying that Indian oil PSUs have signed a deal to buy some 2.2 million metric tons of LPG from the US. So that just came through. I'm not sure what will the value, I mean, it should be large.
Absolutely. And these are all signs about how India can potentially go from 50 down to 25% tariffs for sure. And possibly try to argue for even lower.
That penal tariffs should, I think.
It's just to add to your point, Prashant, the minister's also clarified it's going to be 10% of our total requirement. So it seems fairly sizable. Maybe a step forward in finally,
So I think we import about 65% of LPG, and I think a requirement. And so seems to be a shift away. That's the flash that I'm talking about. All, as Amish said, signs that maybe a little bit of give and take, right? And this is the give in that sense, and we'll see what we get. The assumption is that 25% tariffs should disappear. Should go away, and then of course, the rest of the 25% perhaps will be worked lower as well. In your report, in your published report, Amish, what I'm hearing from you is that don't expect anything super normal from here, right? More normal kind of markets, constructive, and you talked about financials, etc., as a place where one will tend to make money. But any outliers from other sectors, anything you can kind of sort of
So, within consumption, as I was saying, that there is going to be a split between stocks that do well and the ones that don't. So we think that as far as the mass consumption category goes, most of the lower income, middle income households are still in the mode of deleveraging, because remember, since COVID, for 5 consecutive years, they have kept on levering up. And that was reflecting in the unsecured retail growth over the years. So they are now in the phase of deleveraging. So the money that we were discussing, the money that the government is putting in your pocket through tax cuts or rate cuts, etc., that goes to delever more rather than go and consume. But as far as the premium consumption categories go, there, if you're a well-off Indian, whether you invested in equities or gold or property, you've made money, and therefore they were consuming, they will continue to consume. So therefore, we think within consumption categories like travel and tourism, alcoholic beverages, jewelry, four-wheelers. So the more alcoholic beverage, so the more discretionary categories or premium consumption categories does well. At the same breath, things like staples, footwear, apparels, so those are more mass consumption categories. There you will see growth, but it will be a very shallow recovery, because a large part of the money available in your pocket is going to delever rather than consume.
Amish, we leave it there. Good conversation as always. Thanks very much for dropping by to our studios. Appreciate it.
Thank you very much.
Thank you.
All right. That's a view from Bank of America Securities. Well, with that, just a quick glance back on the screen. Markets actually picked up some pace now, 64 points higher. So it's looking a little better for the Nifty. And what is actually taking it higher? A couple of financial names. Kotak is now up over 1%, 1.2% almost. Axis Bank and SBI, SBI Life. So financials have basically started moving. And that's what has gotten us here. Bajaj Auto, by the way, is the leader on the Nifty right now. Stock's doing really well, 1.5% up on Bajaj Auto. Let's, however, move on and get to some more corporate conversations now. IRB Infra saw pretty good growth in tolling revenues. It was about 11% growth in their tolling revenue in the second quarter. Private InvIT won a record 9,200 crore rupee order from the NHAI as well. The company, by the way, changed its accounting policy in the quarter gone by. So we need to also understand really where the performance and the numbers are now. Anil Yadav, CEO of Business Development, is with us. Anil, thanks so much for joining in. So I'll get to that new order and that tolling revenue growth. But can you just run the numbers? Because you had this accounting change. The numbers that we have, your revenue is up about 10.5%. EBITDA margin, EBITDA is up 8%. And the margin is at about 52-53%. How would you, describe the trends in the quarter gone by? Because you seem to have done a lot better than a lot of the other EPC players in this period, which is obviously spoiled by monsoons.
Yeah, so I think if you look at, we operate in two segments predominantly. One is the toll business and other is the EPC. Though there was some, because of the monsoon, there was lower EPC execution, but our toll business has seen a very healthy growth. And if you look at in terms of the toll, the EBITDA margin is 85 to 88%. So automatically the moment composition of the toll increases, automatically your EBITDA margin further improves.
Okay, so let's talk about this toll revenue growth of 11%. I mean, what are the trends? And typically, I think the third quarter anyway is even stronger. So what visibility do you have on the second half now? And anyway, cars have gotten cheaper, right? So maybe more cars on the road and therefore more toll revenue in a simplistic way.
I think the car typically only accounts for 15 to 20% depending upon which highway you are talking about. It's largely the commercial traffic, which 80-85% is the commercial traffic. And definitely the growth in the car post-COVID, we have seen around 10 to 12% growth in the car traffic. And that has led overall traffic also in range of 6 to 7%, some are at 5 to 6%. So considering that now it was extended monsoon and the monsoon this year was severe, we expect that now, now considering the monsoon is over, we expect better toll revenue growth in the coming quarters.
Okay, all right. Hi, Mr. Yadav. Good morning and good to see you. Just to reconfirm the guidance that you had given us earlier, on toll, I think you were working with double-digit revenue growth, and on construction, around 4,000 crores. You could correct me on those numbers. And what is the guidance for this year?
Yeah, so I think the guidance which we have given, we are on that the toll revenue will grow in double digit. And in terms of the construction, we'll be reaching close to 4,000 crores kind of mark for this financial year.
All right. You know, some peers have been complaining about execution hassles, about delays in payments. Have you experienced anything on that front?
So I think there the difference between us and the EPC companies that our 85-90% business comes from the asset business. We have 80,000 crores kind of asset base, and since we have bagged one project, we will be reaching closer to 90,000 crores kind of asset base. So our large portion come from the EPC, and in terms of we don't do any third-party EPC. Predominantly, we do a EPC for the private InvIT, which is owned by 51% by IRB, 25% by GIC, and 24% by the Ferrovial Group. And in terms of toll business, that is the cash collection. There is no deferral of the income. It's basically the moment the vehicle crosses the toll plaza, they pay us. And on construction side also, we don't have any kind of delay in terms of receiving the revenue.
Can you tell us more about the private InvIT and what you're thinking there? What kind of assets are you looking to add? The recent order win, I think it's 9,200 crores, right? So how many more assets are you going to add? What is the plan for monetization? What should we expect on the private InvIT?
Yeah. So I think private InvIT has recently sold, where we own 51%, recently sold 3 of the asset, and in terms of EV was roughly 8,400. They have got an equity of around 5,000 crores. And now they have bagged this 9,270 crores kind of upfront payment asset. And this is the part of Lucknow and Ayodhya and the Gorakhpur, and other part is part of Lucknow to Varanasi. So these are the religious places, and we have seen that the state GDP is doing good. So I think on backdrop of this, this is the good win as far as private InvIT is concerned, and this is expected to, in terms of asset size, expected to increase the asset side by 10%, and similar line in terms of the revenue as well. When we are talking about kind of 10-11% kind of toll revenue growth, with this asset addition, the toll revenue growth will be again further increased by 10%. So we are talking about 18-20% kind of toll revenue growth once this asset starts.
And when will that be?
So I think we have just received the LOA, and we will be planning to make the payment in this financial year. And towards the end of this financial year, that execution of that the project tolling will start, because it's a TOT. So they are tolling post the payment to the authority, the tolling will start.
So you're saying that with the addition of this asset, next year onwards, your toll revenues could go from what is right now about 11%. It could go up to 18%.
18 to 20%.
18 to 20%. Okay.
All right. Mr. Yadav, you could tell us, how is the BOT bidding pipeline, with GIC, Sintra as partners? Will the hit rate of tender wins go up? If you could give us a sense out there, how is the first half of the year transpired, in terms of BOT, TOT awarding? And how is the second half of the year expected to shape up?
Yeah, so I think in terms of, if you look at our market share in terms of TOT, we have 42% kind of market share. If I will talk about just immediate next 1.5 months till December end kind of bidding pipeline, there is almost 25 to 30,000 crores worth of TOT which is up for bidding, and around again 28 to 30,000 crores kind of BOT which is up for the bidding. And we will be participating in this project. So I think the pipeline looks robust. First half, the award was a bit lower, but now it has started. And I think we believe that, we have seen in the past as well, typically the award picks up in the second half of the financial year.
Okay. Also, what about the Ganga Expressway? I think the commissioning is expected in the second half.
Yes, the Ganga Expressway is expected to commission by end of this quarter. So I think that will be the one asset where the tolling will be starting.
And how much will that add? Because you said, with this 9,200 crore asset, you said next year, by the time it's operational, your toll revenue will be, showing 18% growth. As Ganga Expressway gets added up, and what is the expectation?
I think Ganga asset to begin with, it will be not that significant to begin with. It will gradually ramp up. I think since we are too close to the start of the project, once project start, we can share the revenue numbers.
Okay. So just to kind of go back and confirm, what is the yield you're expecting from this asset, the Ayodhya asset, 9,200 crores? And with what kind of margins and what kind of yield does it come with?
I think typically our bidding parameter is around 15.5% kind of equity IRR on which we bid. So that is that same project is also bidded on that parameter. And with the debt equity of 65-35 is the typical debt equity ratio on which one bids.
Mr. Yadav, just to confirm, around 15% ROI.
15%, yes, a return of 15.5% return on equity.
Okay. All right, Mr. Yadav, we'll leave it on that note. Thank you very much for joining in. That's IRB Infra compared to a lot of the EPC players, which have had a complete washout quarter thanks to the monsoons. They've done fairly okay. Stocks also up about 4%. Tolling revenues have been looking strong. We'll take a break on that note, come back on the other side, and we'll have more coming up in just a bit.
Welcome back. Markets doing quite well. We're up close to around 60 points. And the Nifty Bank, the one that we've been spotting, that's the one that's been leading the charge. And in today's trading session, it's doing an outperformance. But the Nifty Bank can only do so much. If the markets need to move up, you need some support coming in from the tech space. So let's discuss that. We're now joined by Sumit Jain, Senior Research Analyst, CLSA, from the CLSA India Forum 2025. Hi, Sumit. Good morning. Good to see you win. Well, we had a brief take from Vikas the last week about IT, and you all have a contra call out there. And, that would be your big call. So tell us the top factors that are making you positive on tech, while, most on the street are a little bit cautious on the sector with regard to growth, with regard to challenges, as well as the global headwinds. Please go ahead.
No, yeah, surely. Good morning, firstly, and thanks for having me on your show. So we have actually been quite positive on the sector almost for last 6 to 9 months, primarily because of the medium to long-term opportunity around Gen AI. I think there has been a lot of talk on the street that there will be a lot of deflation impact because of Gen AI on the existing revenues. But on the contrary, we believe that the technology stack is so complex to build Gen AI applications that you need IT service companies to integrate those solutions. And that's where, we did a lot of in-depth research last year, and we came out with this Gen AI report early in the year in March, and then followed it up with the Gen AI Access Days, where we hosted experts from NVIDIA, Salesforce, people from across technology stack, and they all have to say that they cannot implement their solutions without the role of system integrators. And that's where, I think this year the sector got impacted because of tariffs. But I believe the general narrative on the street that Gen AI is going to have a negative impact on IT services, we don't buy that argument. And in that context, if you look from a macro cycle, we believe that next year is going to be a stronger growth year for Indian IT, in the sense that it's a midterm election year for US next year. If you look at S&P 500 earning growth, as per Bloomberg consensus, it is at 13% right now for the next year, which is higher than last 10-year average of 9%. And as you know, 60 to 80% of revenues for Indian IT come from US geography. That clearly has a positive tailwind for the entire sector. So structurally positive as far as Gen AI is concerned. And mind you, the way cloud technology has evolved over the last 2 decades, AI is ahead of us over the next 2 to 3 decades. So it's not just a 1 to 2 year cycle, but a multi-year cycle where system integrators will have a big role to play. So
Sumit,
positive both from cyclical and structural perspective.
Sumit, hi. Great to have you with us. And this comment that Vikash made last week when he was with us in the studios, it really stuck with me, because I think you all are the very few names on the street who are actually calling for a positive view on IT and saying that, and I remember what Vikash said. He said that Indian IT typically has been not too great at inventing a new technology, but we've been among the best adopters. I mean, using that technology and really, going up the growth curve. So just expand on that. I mean, how do you see this playing out? Because a couple of things are stacked up. One, the disinflationary impact. You just don't need so many people to do more mundane tasks within IT as well. And we've seen maybe some sign of that, maybe not fully. For instance, the TCS layoffs, though they're not equated to AI per se. So just explain the disinflationary part and why you think that's not going to be a problem. And also more structurally, in a world where investors are looking for the technology inventors and creators, I mean, the NVIDIAs of the world, I mean, does Indian IT really stack up? Is it really going to get investors' attention?
No, yeah, I think, the key point, if you look at how Indian IT has reinvented itself over the last 3-4 decades, is by reskilling of their employees around every major technology cycle and making sure that they are involved with their clients to understand their enterprise workflows. And I guess this is where, even if you look at the current Gen AI cycle, the enterprise workflows, the domain expertise is what is required to implement these Gen AI applications. And mind you, Gen AI is just 4-5% of the overall revenues of these companies. So I think the way why we are positive that they will be able to adapt is the reskilling of employees is happening at a rapid scale. Now in the Gen AI world, you need to deliver your solutions along with agentic AI and AI agents. We visited HCL's AI lab just a couple of weeks back, and they showed us how they are integrating their AI agents along with the market available agents like Microsoft Copilot or Google Gemini. So the point is revenue per employee will pick up for all these companies. It will not be a headcount driven model anymore. And that's where I think all the companies, if you look at the last 3 years, the revenue per employee metric has been moving up. And probably we see that metric to further move up. And that I think will be a key thing for us to watch, that yes, these companies are reinventing themselves. So maybe I don't know what it implies for the job growth in India. But as far as these companies' revenue growth or profitability is concerned, we are very confident that they will be able to revive themselves. And the recent quarter results was a reflection of that.
And it's great you're sharing that, because we as people in the media and of course the analyst community, perhaps we'll have an absolutely new way of reading IT company results. And maybe that metric that you mentioned, revenue per employee, that's going to become a big part of how you measure and gauge productivity. Just in terms of revenue growth, by which quarter will it start showing up in the actual revenue growth number? Is it going to be Q2 FY27, Q3? I mean, what are we talking?
See, I think, first of all, we need to understand that this is a mature sector. These companies, in terms of market share penetration for Indian IT, it's already at mid-teens. So we are talking about a growth for these companies probably in mid to high single digits, not in double digits anymore. But these companies are very strong free cash flow generating companies with a very good dividend payout. And that's where, I think the growth for the sector, we believe, will be somewhere in between 5 to 7% in FY27, which will be better than what we have seen in FY26 because of tariff-related concerns. And I think to another point, why we believe that Gen AI is not having a huge deflationary impact is also because BFSI, which is actually seeing tailwinds in US, grew at high single digits to low double digits this year. Even the order booking momentum has been pretty strong. So to your question, I think we have already seen some recovery signs in the recently concluded quarter. And I believe that with a strong order booking momentum, the YOY growth numbers should start picking up from 1 to 2 quarters from now.
Okay, so that's on the growth. Very quickly, just walk us through, by the time we get to this middle of next year, average, what will the margin profile look like? Are you expecting, because of this adoption of Gen AI, are you expecting 100 basis points overall dip in margins, 50 basis? If you're not expecting, then tell us. And just a quick last point on the use of that cash that you said. I mean, great cash war chest, but that's also been one of the biggest criticisms of Indian IT, that maybe they're just not aggressive enough, not looking at quicker reinvention through inorganic growth.
No, yeah, I think there is a clear dichotomy, probably I would say, between the large caps and the mid-tier companies around acquisitions. And I would say probably the global IT companies, particularly Accenture, they have been far more acquisitive, and particularly when a new technology cycle is getting initiated. So probably I think Indian IT companies will have to learn from how the global players have operated across cycles in order to reinvent themselves much faster than those global guys. And in terms of acquisition, it may not be a large scale-based acquisition, but more of capability-led, where they're either entering into new set of capabilities or into new set of clients or new set of geographies. So I agree. I think some part of that cash need to be invested on the M&A side. And I think as far as the aggression is concerned, we have seen some initial signs from TCS planning to invest probably $5 to $7 billion over the next 5-7 years to build data centers. Now, obviously, they are being aggressive, but probably market is not appreciating that fact, maybe because it will have some impact on their free cash flows and ROIC. But yeah, I think they need to be more acquisitive on the M&A side. And I guess to your another question, on the revenue per employee metric, that definitely will be the key thing to watch out for. Can you just, remind me your first question?
Margin, just in terms of margins over the next 4 quarters, should we expect them to go down, stay where they are? What should we expect?
So yeah, on the margin side, we expect them to be very stable, will not have a material impact given the fact that in terms of investment, they largely need to invest on employee reskilling. So there might be some impact on utilization from that in that regard, but no major capex is required. And on the margin side, I believe rupee depreciation will continue to remain a tailwind the way it has been over the last several years. And revenue per employee and pricing, those are the 2 key metrics to watch out for. If they are able to take that up, that will more than offset the investments required to reinvent themselves in the GenAI world.
Yeah. Sumit, more questions, but out of time. Have a good conference, and thanks very much for joining us here on CNBC TV18. So that is Sumit with CLSA. From the sidelines of the conference, a view as far as IT services in India goes. Well, Inox Wind has reported a good set of earnings. Net profit is up about 42%. We have Devansh Jain, Executive Director of Inox GFL Group, now joining us. Just a couple of points I want to highlight before we get into the conversation. So, execution and margins in H2 versus what they've guided. I think that will be something we'd like to understand from Devansh. Demerger and listing of subsidiaries, substations, asset business. And of course, the sharp growth in Inox Green's portfolio is something we'll highlight as well. Devansh, once again, welcome to the program. Are you sticking, first up, Devansh, are you sticking with your guidance of 1,200 megawatts and margin guidance of 18 to 19% for the year? Q2 margins are 20% plus. So will you raise your margin guidance?
Hi, good morning, Prashant and Nigel. Yes, I think we're very happy with the numbers which have just come out this quarter. Of course, H2 is much larger for us. But yes, we are sticking to and maintaining our execution guidance at this point in time. We've just raised it in the last quarter. And I do recognize that our margins have been higher this quarter. And hopefully we should end at higher margins than what we've guided for in the full financial year. But at this point in time, we're sticking to our margin guidance. Naturally, H2 is going to be about 70% of the full year's business. So looking forward to Q3 and Q4.
So it's so it could be 20% plus, on margins and, revenue growth as well.
Well, as I said, we're looking forward to beating guidances which we've set out. We've already done that in Q1 and Q2, in spite of the fact that we've already raised guidances in the last quarter. But yes, hopefully we should outperform.
What's the order inflow outlook looking like in H2, Devansh? You said in your call that you might enter into long-term framework agreements ensuring large recurring annual orders.
Look, again, I would reiterate, I think our current order book is very, very strong at about 3.2 gigawatts, which gives us very, very clear, strong visibility for the next 18 to 24 months. Having said that, orders are the least of our worries. We've recently announced about 300 megawatts of orders. Lots of orders are in advanced stages of closure, which we will keep announcing as we move forward. But I think what we're looking to do now is strategically shift to framework agreements to secure multi-year orders. And I think that's something which we announced in this quarter, that we're looking at a couple of framework agreements, which should give us at least a gigawatt of recurring orders annually for every year for the next 3 to 5 years. So I think you should be hearing a lot more from us on that as we're moving forward. But I think it's looking very, very strong.
All right. Hi, Devansh. Good to see you. Give us an update on the demerger of the substation assets from Inox Green and its merger into the other subsidiary. I think that's Inox Renewable Solutions. Give us some timelines. And also basically, with regard to this demerger listing of IRSL, what's the benefit to Inox Wind? So an update on all of this.
Look, I think what we're doing is we're basically demerging the substation and the EPC arm of Inox Green Energy Services. And in the same scheme of things, consolidating it with the EPC arm of Inox Wind, which is under a company called RESCO, leading to automatic listing or what we call Inox Renewable Solutions, which will become the group's arm for all EPC works, for all our crane operations, for all our transformer manufacturing operations, and for the huge land bank and project site inventory, which is upwards of almost, say, 14 gigawatts of hybrid connectivity and sites which we control. The shareholder and creditor approvals are already in place for this. I don't think it should be too long. I think it should be the next few months. I'm not committing to timelines simply because NCLT is not in our control. We've done everything which we could as shareholders, management. As I mentioned, we've got all our approvals in place now. But I would expect in the next 4 to 5 months, we should see this business hopefully being demerged and listed as Inox Renewable Energy Solutions Limited. What that does is it creates a lot of value addition and is value accretive for both Inox Wind and Inox Green, simply from the perspective that Inox Green has a depreciation charge which moves out because we're removing this gross block. It also increases the ROC and ROE at Inox Green level. And at Inox Wind level, it leads to significant value unlocking and further shareholder value creation because the intrinsic value of the entire land bank and EPC arm gets unlocked. As I mentioned, this also, Inox Renewable Solutions also controls the transformer manufacturing business as well as the crane ownership and operation business. So all in all, a fairly interesting niche infrastructure engineering play, but very value accretive for both Inox Wind and Inox Green.
All right. Let's focus on Inox Green. Now, the portfolio is significant in the O&M segment because of the acquisitions that you're doing. And you have stated that Inox Green will become the largest renewables O&M company in India, I think so. Give us an outlook. How does it reflect in terms of numbers, ballpark revenue, EBITDA, profitability?
Look, so I think given our organic growth as well as some of the strategic investments we've made, through which we control, approximately 6.5 gigawatts of wind operations, our total O&M powered Inox Green currently is about 12.5 gigawatts. A lot of this, I would assume all of it, the entire 12.5, would be reflected in our financials in FY27. I think I can't commit to exact timelines, whether it's 3, 4, 5 months. But as I mentioned, over FY27, all of these investments should reflect in actual numbers. As I mentioned to you, we already control these companies. It's more a matter of time when they get reflected in exact financials. But certainly in FY27, you should see a multiplication, manifold increase in our profitability as the true reflection and full numbers of these 12.5 gigawatts start getting reflected. In terms of actual top line, I think 12.5 gigawatts should lead to approximately about 1,250 crores of top line. And at about 50% margins, that should, you can do the math, that should be at about 50% EBITDA margins. Having said that, I think we've also publicly stated that we're on track to become India's largest renewable O&M company, simply from the perspective that if you look at what our group IPP is doing, Inox Clean, as well as the solar manufacturing arm is doing, we expect to add, on average, between Inox Wind, Inox Solar, and Inox Clean, at least 5 gigawatts of capacity at Inox Green level every year. And this is besides the fact that we're still looking at multiple inorganic additions. So, I think next couple of months, we are well on track to become India's largest renewable O&M services company. But more importantly, at the scale of 12.5 gigawatts, we've created a very, very strong annuity business with very, very long-term contracts, which are married to us for life. And it just makes Inox Wind that much stronger because now we have a very large annuity revenue pool, besides the fact that the wind turbine manufacturing business, in any case, is a fairly high EBITDA margin business for us.
Very, very aggressive targets, very focused. Devansh, pleasure speaking with you. Thank you very much for joining us. Had more questions, but out of time since we are still... Earnings season has ended, but earnings, we're addressing a lot of earnings, so that's going to be the focus as we go forward, at least over the next 1 or 2 days as well. Thanks very much once again, Devansh. So a lot of guidance, especially on wind and, of course, green as well. Well, time for a quick commercial break here. On the other side, Manisha will be focusing on what's happening in commodities, what's top of mind. Stay tuned. Coming up.
Welcome back. Let's talk commodities. Manisha is here with all the headlines. Manisha, so what's hot this Monday?
Not really hot, but we're looking at silver right now. That is because after October, November seems to be ending on a negative note again. We've seen all-time highs in silver for the month of October, but it hasn't been able to sustain there. So $54.50 an ounce is an all-time high. But since then, we've seen prices continue to decline, 2.5% of a decline on a month-on-month basis. And since the month of October, we've seen 54.5. Silver actually has seen a range of anywhere between 48 on the lower side to 54 on the higher side.
Having said that, silver clearly has been an outperformer when you look at various other commodities where energy is in the negative, base metals just about 20 to 30% higher, but silver is giving you 76% of returns in this year till time. If you look at the chart on how we have been in this year for silver, we started the year with 29.5. It was by the month of June, mid-year, that we had already crossed nearly $8 to $9 in cents of silver. And then 40 was as easy, and we saw $45 an ounce for the month of September. And since then, it has been nearly $10 of a gain in the next 2 months, where we saw 54.5 at an all-time highs, and 50.5 is where silver is trading at this point in time. So very, very strong gains, as you can see. The whole year, every month almost gave you strong returns when it comes to silver there. Well, we have seen tightness in sense of supplies. This is a fifth straight year of deficit, with the markets believing that until 2027, it could continue to be a deficit of a market. Apart from that, there also has been very strong investment demand that we saw in silver this year. Remember, this year started with the saying that silver will outperform, and that perhaps is the way to be. And then the way silver kept rising, you saw HNIs, physical buying, ETF buying, all of that continuing quite strong. And then the industrial demand has been on the positive side as well. So whether it's from green energy, solar, electricals, electricity, all of that demand also came in very, very strong there. When you look at the forecast going forward for 2026, the expectation is that silver perhaps could consolidate to perhaps continue to make higher highs. So the most bearish of numbers really seem to be coming in from Macquarie at $34 an ounce. That perhaps might go change going forward, because we're trading almost $15 higher from those kind of levels. World Bank believes that 41 of an average is what you could be looking at in the next year. And then it is between 43 to 45 from Citi, HSBC and Deutsche Bank as well. But then there are bulls into the market as well. ING believes that 50 of an average is what you could see in the next year. And then you have 56 coming in from Wisdom Tree. Most bullish, clearly, are Bank of America and Goldman Sachs, anticipating newer all-time highs and $15 higher from where we're trading right now. So while we're trading at $50 an ounce, 65 of an expectation is what is coming in from both of these banks for 2026.
Okay, all right, Manisha, thanks very much for that. So that's commodities in focus there. Time for a quick break. On the other side, our special Market Master segment, Lata in conversation with Timothy Moore of Goldman Sachs on why Goldman has turned overweight in India after a full 1 year. Coming up.